Hi, I'm Jimmy. In this video, we're going to look at some recent developments that have happened with the US economy and some things that have come out of the Federal Reserve that will likely have a very big impact on the stock market for a long time. Okay, so there are a lot of things that affect the broader economy, and I'm sure we all understand that. And on this channel, we do a monthly analysis where we go through different leading economic indicators to try to sort of score where the economy's at. And I find that personally, that research to be very interesting and helpful. But I thought it could make sense to go beyond the numbers and to look at the current economic situation that could lead us for the next couple of years. And hopefully we can use this information to make more informed investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so first we have the job situation. Now, unemployment is sitting at about 8.4% right now, and that's clearly a bad thing, especially when we consider that before the coronavirus happened, unemployment was less than 4%. And when we look at unemployment going over the past 10 years, well, it hasn't been this high since the economy was coming out of the financial crisis of 2008 and 2009. So it was about 2011 or 2012 when it was back this high. And like most economic recoveries, it took a long time for unemployment to get back to a reasonable level. Now, of course, this recession is a little bit different because the world was sort of forced into it by the coronavirus. So that helps explain how it got up so fast and also why the decline has been fairly sharp as well. And this is a good thing. But when we shift over to initial jobless claims, well, we can see that jobless claims are still quite high. Now, they are declining, so that's a positive thing. But as of the most recent number, they still lost last week, 790,000 new jobless claims were filed. And so that's a big number. Now, I also should point out that there are actually two different jobless claims numbers. If you were to Google it, you might see a headline that looks something like this. And they're saying the number is actually 860,000, and this is true. But the key difference between their number and the number that we're looking at here is their numbers is adjusted for seasons. So it's seasonally adjusted. Our number is not seasonally adjusted. So these are just what was the actual number. Now, the seasonally adjusted number isn't necessarily right or wrong. It does make sense to adjust those numbers on a seasonality basis, since there are some jobs that come out in the summertime that simply aren't there in the winter, and same is true vice versa. So I understand you could really use either, and if we were curious, when we shift over to the other number, it doesn't look that far off. So this one is seasonally adjusted. And if we were to switch back and forth for a second, once again, they're not that different. So if you're ever curious why this number is different than what you might see in the headlines, that's probably the reason. Okay, so long story short, the job situation is improving, but it's not great, and it's probably going to take a long time. Now, if we were giving a point to the Bulls or Bears, I would still give this point to the Bears in this scenario because these are a lot of jobs to be losing. Unemployment rate is still very high. And I think that the decline that we've seen in jobless claims or unemployment is going to begin to level off because some jobs simply aren't going to come back that fast. And this brings us to the Federal Reserve. So the Fed recently released a statement where you might have seen headlines that look something like one of these. Basically, they're saying that they're going to keep interest rates near zero through 2023. Now, if we were to think about it, that's actually not that surprising. I'm not really sure that's headline-worthy news, since if we think about this chart, this is the Fed funds rate going back to right after the financial crisis, and look at how long they kept interest rates fairly low. Sure, it's lower today, but still, they kept them there for a long time. But here's one of the interesting things that did catch my attention. So many professional investors pay very close attention to what the Federal Reserve says. After all, I think we can all agree that the Federal Reserve has a huge impact on the economy and on the stock market. So if you're doing that for a living, why not pay close attention to what they say? And one thing that I used to have to do when I worked at some of the smaller firms that really didn't have the resources to pay for services that do this for you is you would compare one Fed statement to another Fed statement to see what has changed. Now, I'm not talking about the general tone from one statement has changed to the next. I'm talking word for word, what did they change? To illustrate, going back to January of 2020 of this year, so it's this year before the coronavirus really hit, this is what the statement looked like. As we scroll through this one, well, we can see that they first changed the month that they were talking about. That's an obvious change. Then they changed the word from strong to moderate, and I'm sure that made a whole bunch of headlines back then. And then they adjusted the wording around inflation. Okay, so as we can see, there's not too many changes from one statement to the next. And if we look at September of last year, well, that statement, once again, this time we've highlighted the changes. These are the two changes side by side. And as we can see, just from a cursory glance, there are not too many changes. Now, they did add this paragraph down here, and usually that's what you're looking for. When you're analyzing these statements, it is what are they changing, what are they adding, what are they taking away, because that will give us an indication of where they're heading. But as the economy gets in trouble, very often the Fed has to do more, so they have to explain themselves. Well, this is what the September 2020 statement looks like that came out just a few days ago. And as we can see, they made a ton of changes. In some cases, they deleted paragraphs, they added or at least replaced some other paragraphs. Now, of course, it's not the fact that they're making changes that is in itself a big deal. It is the fact that we know that they're making changes because they are changing things on the fly, let's call it. We know that they're doing this because they're trying to adjust as the economy needs adjusting, call it. Now, I've spoken in previous videos where we talk about the Fed saying that they're going to adjust how they look at inflation. Basically, they're going to use average inflation versus actual numbers, which in theory will lead to higher inflation over the long run, which ideally it's not a great thing. That really should be avoided if they can help it. Now, what's making the most news out of this particular report is this section right here. And basically what they're saying here is that the Federal Reserve has decided to keep interest rates near zero until unemployment gets to what they define as maximum employment. Now, my concern with this is what if the unemployment rate, which has been dropping at a fairly decent rate, begins to drop more slowly. In theory, it could take many years to get back to, let's say, 4% unemployment. And if that's the case, are they going to keep interest rates near zero that whole time? It sounds like that's what they're saying. Now, from a stock market perspective, well, this should lead to a higher stock market, and we've seen this already in 2020. Look at how high the stock market has already gone, despite the fact that the broader economy doesn't really warrant a stock market near all-time highs. Another serious change to consider that could happen is that debt could seriously get affected. Now, of course, debt is already, broad debt I'm talking about, is already in this situation. But every now and again, I come across a comment on whatever YouTube video, and people are talking about how bad debt is. But I would make the case that not all debt is created the same. For example, if we were to start a company, and that company, we needed money to get started, and perhaps we had some savings, but we wanted to borrow a little additional money. We've decided that we can afford, let's say, $1,000 a year in interest payments. We don't have to pay the principal till the end, much like a typical bond. Let's say 10 years from now, how much money can we borrow? Well, if interest rates are, let's say, 10%, well, we can borrow $10,000 and afford the $1,000 a year payments. But what if the bank came back to us and said, we'll give you that same loan, but we'll give it to you at 1%. How much would you like to borrow now? Well, according to that same math, we could now borrow $100,000 and it would have the same impact from a cost perspective on an annual basis. Is this a smart loan for us to take out? Well, it really depends on what we're doing with the money. If we're a brand new company, we're just getting started, maybe an interesting situation would be Amazon when they were first getting started, or Google, any one of the major companies today that grew fairly quickly. A lot of times, big capital early on helps you grow. Point being is that with lower interest rates, you're able to borrow more money with a less of a negative impact on the overall company. Now, of course, this could lead to bigger problems down the road. When interest rates do begin to move higher, well, the companies that loaded up on debt today could end up in more trouble later. So I'm not suggesting for 1 second that, it's okay because interest rates are low. It's okay for companies to take out a ton of debt. But what I am suggesting is that we should analyze, whenever we're analyzing a company, we should analyze what kind of debt they have, what interest rates are they paying, and how are they using the money that they're bringing in to affect the growth of their business. If it's done smartly, borrowing money can be a very, very smart move. But if we're long-term investors and we're planning on holding a stock for, let's say, the next 30 years, well, I want to invest in management companies that can use debt strategically but not recklessly, because right now that debt could make sense at near zero, or, in the case of a AAA corporate bond, maybe 2 or 3%. That debt could make sense, but what if that same debt went to 5 or 6%? Well, now it might not make as much sense. So I don't want the companies that I would invest in to load up too much. So despite the fact that the Fed is going to leave interest rates fairly low, we also know they're going to let inflation move higher. Well, in my mind, these are actually indications of making investing a smart move. Assets, the stock market, real estate, tends to do fairly well with some inflation, not too much, a little bit of inflation, and it does fairly well with low interest rates. So if we've been sitting on the sidelines, it might make sense to invest for the long run and to use what the Fed is setting up for us to help all of us profit our own investment portfolios. And if we're curious, I actually did a video on how to analyze the debt of a company that hopefully helps you in your analysis of whatever company you're looking at. If you're curious, I got a link right here. I got a link in the description below. And I want to thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.